Hey there, my name is Russ Horn, and today I want to show you this system completely for free. I'm going to show you how to trade the Forex Power Pro trading system. Again, this is 100% for free, and on this page, you're going to find the download link to the auto installer and the PDF manual for this. I think you're going to find this system to be easy to trade, and it is a profitable trading system. I've used it for a very long time, and it's serving many traders very well to this day. And again, I think you're going to get a lot out of this one. Now, once you've downloaded this, please leave a comment below, as there are going to be some pretty neat prizes for you to win today. All right, so with the Forex Power Pro system, I want to show you exactly how this is traded and some tips and tricks to make this an even better trading system. I've downloaded the Forex Power Pro zip file. This contains the auto installer and the manual. I'm going to show you in this video how to run the auto installer to get the Forex Power Pro template onto your MT4 charts. And I'm also going to show you how to install the MT4 template manually. Sometimes if you have an antivirus that does not like an exe file, you won't be able to run the auto installer. So I'll show you how to do that manually. Now, the first thing I want to do is open this Forex Power Pro zip file. And inside, we'll see we have a folder, a Forex Power Pro folder. Now, the one thing I want to mention before we continue is I use a program called WinRAR, and with WinRAR, I can manipulate these files within the zip folder. You may need to extract these files to your desktop. If you do, go ahead and do that. But once that's the case, open the Forex Power Pro folder, and inside the folder, you're going to see a PDF manual. You're going to see a folder that says templates, and you're going to see a Forex Power Pro exe file. This exe file is the auto installer. So I'm going to double click this to run it. And with that, I get this installation wizard. Now I'm going to close the zip file, and on the installation wizard, I'm going to click next. And I get this error message. This is the installation wizard detecting that there is a MetaTrader program currently open. So I'm going to close this MetaTrader platform simply by clicking the X. And with that closed, I'm going to click OK. And from here, I'll accept the agreement and click next. And by default, the installation wizard is going to select every platform that it can find on your computer. If you don't want to install this on certain platforms, just uncheck the ones you don't want installed. I'm going to keep them all checked. And from here, I'll click next and next again. And now we've got it installing. And once that's finished, click next. And from here, the box, run this MetaTrader application is checked, and it shows you what platform it's going to run. I don't want to run that one. I'm going to uncheck the box, and then I'll click finish. And from here, I open the MetaTrader platform that I had just closed. And finally, I'm going to go to the templates and choose load template. And I'm going to look for Forex Power Pro, and that's it right here. I'll click it and click open. And this is going to apply the Forex Power Pro to your chart. All right. Now with the auto installer done, I'm going to show you how to install the template manually. We're going to start from the beginning. I'm going to open the zip file. And again, open the Forex Power Pro folder. And now we have this templates file folder. Now, before I do anything with the templates file folder, I have to open the data folder of the MT4 platform, because we're going to be dragging and dropping the template from the zip into the data folder. So from here on the platform, I'm going to, in the upper left-hand corner, click on the file, and then I'm going to click open data folder. And this is going to bring up the data folder that the MT4 keeps all of the indicators and templates and profiles and so on. Now back to the zip file, I'm going to open the templates file folder to get to that Forex Power Pro TPL file. And then from here, I'm simply going to drag and drop it into the templates file folder in the data folder. And now I get this pop-up that says replace the destination file, because we did just run through this installation process and I do have it on this platform right now. But yes, I'm going to replace the destination and it's installing. And with that, I'm going to close both of these windows. I am going to close the platform again and now reopen the platform. And with that platform reopened, the same process applies. I'm going to hit templates. If you don't have too many templates, it'll be in this list. But me, I'm going to click load template. And then from here, I'm looking for the Forex Power Pro. Click that template, click open. And again, I've got it applied to my MetaTrader chart. So the first thing that I want to do is cover the indicators. I want to explain what the indicators are and what they do. Now, these aren't custom indicators. You'll be able to set this up on any trading platform that you decide to use. We do have an installer for MetaTrader, but you can use this on any trading platform. This was designed specifically for this so that it can be traded anywhere you want to trade it. So to begin with, I want to focus on these moving averages. There are 4 different moving averages on the chart. And then underneath, we've got an RSI with a moving average. So let's start with these moving averages. Now on this chart here, I've taken away a couple of the different moving averages. And what we're left with is a 20 EMA of the highs, which is the blue one, and a 20 EMA of the lows, which is the red one. These are going to be your buy and sell moving averages. They are going to give us the signals in order to buy and in order to sell. Now, with those signals, we're going to confirm that with the RSI. This RSI is going to give us a bit of a filtering effect. Now, this is a 10-period RSI, and we also have a 10-period SMA, a simple moving average applied to the RSI, and this also is going to help filter the RSI. Now, with that, let's go to the next set of moving averages. This is the 10 period of the high and the 10 period of the low. Now, with the 20 periods, those solid moving averages that we had, those are going to get us into the trade. They're going to signal the trade and the direction that we want to trade. And these 10 period moving averages, they're going to be how we manage the trade. Now, with these moving averages, you're going to see that the 10 period is much quicker than the 20 period. The 10 period EMAs are closer to the price. So if we use the 10 period EMA to trail our stop loss or to manage the trade, we're going to find that if the trade does lose, we're not going to give back too much of our profits in a losing trade. And that's really important. That is one of the keys to succeeding as trading is trade management and having the appropriate method to trail your stop loss so that you do let the market breathe. But at the same time, if the market is going to change direction on you, that you're not going to give back too much of that profit. So we'll go back to that original template, and together we can see how the 20 EMAs and the 10 EMAs are working together. Now, the blue is for buy and the red is for sell. So if we are going to sell, we're going to look for a close below this red 20 EMA, and then we're going to use this red 10 EMA along the top as far as the trade management goes. So the red moving averages are for sells and the blue moving averages are for buys. So when we're looking for a buy trade, we're looking for the price to close above this blue 20 EMA, and then we're going to manage the trade along the blue 10 EMA. All right, so as far as the rules go, let's take a look at a couple of different setups. We're going to look at the buy and we're going to look at the sell. So let's zoom in a little bit here. We're going to get closer up into the chart, and I'm going to put a vertical line on this candle right here. So we're going to take a look at our first buy. Now, if we go down to the RSI, we're going to see that we have 2 lines instead of 1. Generally, the RSI has a center 50 level. And on this particular one, we've got 2 center lines. We've got a 55 and a 45. Now, this gap in between the 55 and the 45, this is what I consider the neutral zone. The RSI can often get into the neutral zone and provide us with a really choppy signal. We can get in and out of trades as the price is jumping back and forth above and below the 50 level. And we want a way to sort of avoid that chop. And in order to do that, what I've done is expanded that 50 level a little bit, 5 in one way and 5 in the other way. So we have now this kind of window. Again, it's a neutral zone. And when the price is above the neutral zone, we are going to find that the market now has some momentum. When the RSI is above the neutral zone, we're going to find that the market now has some momentum. And when the price is below this neutral zone, we're going to find, again, that the market has some momentum. If the RSI can get above or below its 55 and 45 levels, we're going to often find that the price or the market is going to want to continue in that direction. And as a trader, that is exactly what we want to see. We want to see that the market continues in the direction that we place a trade. With that being the case and that being said, let's take a look at a couple of examples. I want to show you what a buy signal looks like, and I want to show you what a sell signal looks like. So I'm going to zoom in on the chart so we can see these candles a little bit better. And I'm going to mark off the first buy one that I see here. So we've got a buy signal right here. And by the way, this is the Euro Japanese yen. This is a 4-hour time frame. This is a current chart. And I want to use charts as current as possible, just so you can see that this is valid for right now. It's not something that I have to scroll back years and years in order to find market movements to make this work. This is something that we're using in real time. All right, so this is the signal to go long. So on this one candle right here, we have a signal that we can use to go long. Now, the two different requirements for this signal, what makes this signal an actual signal, is A, we get a close above this 20 EMA. So this blue moving average has the candle closing above it. So at this point, we've got the candle closing above that 20 EMA. And if I put a vertical line on this, we have the second requirement as well. And this is the RSI moving above that 55 level. So this top level on the RSI is the 55. And we want, at the close of that candle, the RSI to be above this 55 level. Now, with that being the case, we also want to see that the RSI, which is the blue line, is above the red moving average. So we've got a 10 simple moving average, or a 10 SMA of the 10 period RSI. If the RSI is above the 10 SMA, we've got some momentum in that upward direction. Now, there are going to be times where we do get signals in one direction or the other, but the SMA of the RSI is in the way. And we're going to often find that it does act as a really nice filter mechanism. It's going to keep us from getting into these trades where the SMA or the moving average is in the way. So at the close of this one candle, we've got ourselves a signal to go long. So let's take a look at a sell signal. Now, we've got one right here. This is a current one, and we've got another one right here. So let's take a look. Well, we'll take a look at both of them. So this is the current sell signal. This is the previous sell signal. So we've got two sell signals going on. And if we take a look at this, this is our signal to go short. This is on that first one. This is the signal to go short. This is on the second one. And again, I'll explain exactly what that signal is in regards to the different steps. So this signal being short, what we're looking for is a close of this candle below this red 20 EMA. We get a close below that red 20 EMA. We're going to move down and take a look at the RSI. And we want to see that the RSI is below this 45 level, this bottom level. And we also want to see that the RSI, or the blue line, is below this moving average. We can consider this moving average kind of like a signal line of sorts. You'll be familiar with it on something like a stochastic oscillator where it's called the signal line. But what we want to see is that RSI being below that signal line in a sell trade. So we have those requirements met on this one candle right here. So this candle is the signal to go short. And if we take a look at that, at the current candle, this current signal, this is the most recent signal that we have. This is also going to give us that opportunity to take a short trade. Now, at the close of this candle, we're going to see that it has closed below this red 20 EMA. And if we look down along this vertical line, we're going to see that at the close of that candle, the RSI also is below that 45 level. So we have the RSI below the 45 level, and that implies that we do have some market momentum to the downside. So we've got that RSI below the 45 level. And on top of that, we've got that RSI below the simple moving average, this 10 simple moving average. So we've got all the criteria met for the short trades. All right, so that is the signal for the trades themselves, which is really straightforward. It's really simple. Let's take a look at where we're going to place our stop losses for this. Now, the stop loss is going to be positioned using these 20 EMAs as well. So in the case of this long trade, so this is our buy trade right here. We're not going to use the candle. We're not going to use the market swings. We want to keep the stop loss in a safe place, but we also want that stop loss to be as close to the entry as possible. When you have a stop loss that is as close to the entry as you can safely get it, what that means is the price does not have to go too far in order to hit your take profit. So if you have a huge stop loss, you're going to essentially need a huge take profit in order to make that trade profitable or make it work for you. In order to prevent a huge stop loss, we want the stop loss to be smaller. Now, we are generally going to go for one-to-one profit targets. So if we can reduce the size of the stop loss, we're going to be able to reduce the size of that take profit. So if we take a look at this one, if I had placed the stop loss in the traditional place, which would be underneath this recent swing low, we'd be looking at about a 270 pip stop loss. Now, the market does end up going that far. Just barely, but it does do that. But the market really does have to put an effort in to get there. Now, with the 20 EMA, the stop loss has been reduced to about 120 pips. So we have a much smaller stop loss, meaning that with 120 pips, we are able to get out of that trade successfully much, much quicker. So with the stop loss, we are going to place this stop loss not on that 20 EMA, but just below it in the case of a buy trade. So we've got that entry as the price closes above that 20 EMA. We've got that stop loss just below the 20 EMA of that entry candle. Now, if we take a look at the stop loss placement for the sell trades, again, we've got two of them here, so we'll look at both of them. Take a look at this current one. So this is the sell trade. This is the current sell trade. Now we have the close of that candle below the 20 EMA. So our stop loss now is going to go above the high, above this blue 20 EMA. So our entry is at this level right here, and our stop loss goes just above the 20 EMA of that signal candle. As soon as this candle is closed, this next one opens, we take a look at that closed candle. Where is the 20 EMA? This is that 20 EMA location. Now, I'm not going to place my stop loss right on the 20 EMA. That is just a little bit too close, but just a little bit above it. Now, there is going to be a personal space that you are comfortable with. And that personal space that you're comfortable with is going to change from time frame to time frame. This is a 4-hour time frame. So I've got it on this one placed about 10 pips above that 20 EMA. On something like a 5-minute time frame, it might be 1 pip. But you're going to find this space that is more or less comfortable for you. So we've got this one placed. We've got our stop loss just above that 20 EMA, and the market now is continuing to move in that trending direction, ideally going to take us out with a profitable trade. Now, if we take a look at this on this other one, this other short that we had right here, this is the entry. So we've got that entry candle right here. This is going to be the entry level. So when this candle closes, to give us that signal, I'm going to take a look and see where that 20 EMA is. And that's right here. So the stop loss now goes just above that 20 EMA. And that stop loss is right here. So in this case, we're looking at a stop loss that is about 85, 86, 87, maybe closer to 90 pips. So we've got that 90 pip stop loss, which is much better than what we'd be looking at traditionally, which would be above the swing high, which is 175 pips. So we have a stop loss that is about half the size of what we would initially be placing it. Now, with a stop loss that is half the size, what that means is the market, if you're going for something like a 1-to-1 target, and again, it doesn't matter what the target is. If you have a 1-to-1 or a 2-to-1 or whatever the case is, if you have a smaller stop loss, in order to get a 1-to-1, the market has to move less in order to get there. And if the market does not have to move as far to get to the target, it means you have a higher probability of a successful trade. All right, so that is the stop loss placement. Now we are going to take a look at the targets for this. With the buy trade, again, we're looking at this one as the buy trade. We have our entry. We have our stop loss just underneath the 20 EMA. By default, I like to go with the 1-to-1 profit target. It is generally the easiest for the market to hit. If you have a 1-to-1 profit target, there's a way that we're going to implement our trade management to make that 1-to-1 profitable. So even if you are only winning half of your trades, you're still going to make money with this. So the 1-to-1 is the easiest for the market to hit. And if you have the market hitting your 1-to-1, then you're on to the next trade that much sooner. Now, you do have options with this. It's not written in stone. When it comes to a lot of trades, I do like to go for the 2-to-1s, especially if I get an instance like this where I'm using the 20 EMA and I can make my stop loss a little bit smaller. So if I go for a 2-to-1 target, and again, it doesn't have to be 2-to-1, it could be 1.5-to-1. And if I'm targeting a little bit more than what the stop loss is, then I'm putting that much more of the odds in my favor in order to make money trading. By default, we're looking at the 1-to-1. So let's take a look and see where that would be. And I'm just going to measure this. So we have a stop loss of 120 pips, and our profit target also is just about 120 pips. So after 1, 2, 3, 4, 5, 6 candles, we get our target tagged and we're out of that trade. So we have this one-to-one target getting us out of the trade fairly quickly. Now let's take a look at the sell trade. Now this one, it hasn't hit our target yet. So this is a really nice example to look at. So this becomes the short trade. We know that this is the signal to go short. We have our entry. We have our stop loss placed just above that 20 EMA. And with this, our one-to-one is going to be just about here. So let's take a look at the numbers for this one. We'll say 120 pip stop, which means we're looking at about 120 pip profit target on this. Now we just about got to it. It hasn't hit it yet, but I'm fairly confident it will. So let's take a look at this sell that did get all the way through to our stop loss. We know how this one worked out. So if we take a look at this one sell trade right here, we're taking a look at the entry at the close of this candle. We're taking a look at the stop loss above that 20 EMA. And now we're taking a look at a one-to-one profit target, which should be right around here. So if I look at the numbers on this, we're taking a look at about an 85 to a 90 pip stop loss. And so we've got a 90 pip profit target as well. This one went really fast. It only took 2 candles to get to that profit target. When you've got the momentum on your side, oftentimes these trades don't need to last very long in order to hit your profit target. All right, so we're going to take a look at trailing your stop loss. Now, this is where the 10 EMAs come into play. So we'll go back to this long trade right here, and we're going to manage the trade. And when you manage the trade, you're essentially trailing your stop. You're going to reduce the risk on your trade. So let's throw those lines back on the chart. We've got our entry. We have our stop loss, and we're looking for the market to hit our one-to-one. Now, as this trade continues, as this trade moves, we're going to want to reduce the risk on this trade. So again, let's take a look and see what this one is. So the risk on this one is 120 pips. So we want to keep that in mind. It's going to come in very handy to see what does happen. Now, I'm going to use this 10 EMA as the method to reduce the risk on this trade. So this next candle opens. I want to see where that 10 EMA is. Now, if I put my vertical line on this candle, we can see that the 10 EMA at this point is below the current stop loss. So I don't want to do anything just now. I don't want to manage the trade yet because that 10 EMA means I would have to widen the stop loss. And that is something you do not want to do when you're in a trade. Once that stop loss is placed, it is put in the appropriate position. You by no means should be making that stop loss bigger. So if the 10 EMA is further away than the stop loss is, then we don't do anything. We just keep that stop loss where it is. Now this candle closes and the next candle opens. And what we see is the 10 EMA and the current stop loss are in about the same place. So again, we don't do anything at all. We're going to keep that stop loss where it is. And finally, this next candle opens and we can see that 10 EMA is above that initial stop loss. So we're going to take that initial stop loss and move it up a little bit, not right on the 10 EMA, but just a little bit below it. So the next candle opens, we have a higher 10 EMA. That stop loss gets moved to accommodate that new location of the 10 EMA. The next candle opens, again, the 10 EMA is higher. So we're taking our stop loss and moving it here to just underneath the new location. This last candle opens. This is the one that takes us out of the trade. But when it opens, the position of that 10 EMA changes. So again, we're going to manage the trade. So this is where we ultimately end up with the position of our stop loss. Now, if we take a look at this, remember that the stop loss initially on this one was 120 pips. So now I'm going to take a look and see where we managed the trade. It's 40 pips, 41, 42 pips. So we had taken that stop loss and reduced the risk on this trade by 2/3. We've managed to make this trade much less riskier than the initial position that we took on this trade. So if at this point the market comes up, doesn't quite get us out by hitting the target, ends up reversing on us and takes us out, it hits our stop loss, we lose the trade. We lose 41, 42 pips instead of the initial 120 pips. And that is going to be something that we can easily recover on the next trade. So let's take a look at the current trade. This is the current short trade, the current one that we could be in. So let's put our levels on the chart, and that's going to include our profit target. So let's take a look and see what the stop loss is approximately on this one. So again, 120 pips. We're seeing a theme here. So we've got 120 pips stop loss, and we are noticing that at the close of this candle, we have the open of the next one. We're going to take a look and see where that red 10 EMA is. So now, because it's a sell trade, we're taking a look at the red indicators, the red moving averages. So we have the red moving average at about the same location as that initial stop loss. So with this one, we don't move the stop loss at all. We're going to leave it alone. Now, the next candle opens. When that next candle opens, we get this red 10 EMA dropping down. So we're going to move that stop loss to accommodate that red 10 EMA. Again, the next candle opens, that 10 EMA drops a little bit lower. So we are managing the trade to accommodate that new location. And this current candle, this one has opened and has given us a new current location, which is right here. So now, if we were to lose the trade right now, let's say this market doesn't tag the target and it reverses on us. And on this very candle, it decides to shoot up and take us out of the trade. What we would lose on this trade, instead of 120 pips, is 60 pips. We've already reduced the risk by half. We have taken this trade and reduced the risk by half. So if we were risking 2% on this trade, the most that we could lose on this right now is 1%, simply by using this 10 EMA trailing method to move the stop loss closer and closer to the entry. Now, there are going to be times where you find that that 10 EMA gets beyond that entry price. So your stop loss will literally be on the profitable side of that entry. When that does happen, no matter what happens, you're going to make money on the trade. You're either going to hit the profit target or you're going to get stopped out. But if you get stopped out, it'll be in the positive territory. You'll be stopped out at plus 10 pips or plus 20 pips or whatever the case is. So this is how we manage the trade with the Forex Power Pro moving averages. Now, this is a really simple trading system, and there's not a lot more that you need to know. But there are a couple of things that I am going to tell you. I'm going to show you a couple of extra little things. Now, the first thing is letting a trade run. You might want to let the trade get as much as possible. You might want to let the trade run. And a lot of traders do this. They want to let the trade go as far as they possibly can. They don't want to use a target. They don't want to have a 1-to-1 or a 2-to-1. They don't even want to set a target. They want to let the stop loss take them out of the trade. And if that is the case, what you'll do is you'll simply continue to use that 10 EMA to get you out of the trade. So we're going to take a look at this one. This is a really nice example. So I'm kind of cherry picking this, but it'll give you the idea. So if we take a look at this, we're going to place our entry. We're going to place our initial stop loss. And now we're simply going to let this trade run. So as this trade goes, we're going to follow it along this 10 EMA. Now, the initial stop loss on this one is, let's say it's 90 pips. The initial stop loss is 90 pips. And as this trade progresses, every new candle that opens, we get a new location of the 10 EMA, and we're going to manage the trade with that. And our stop loss is what's ultimately going to get us out of the trade. So again, I'm going to follow along this 10 EMA with the stop loss until the stop loss gets hit. And we get our stop loss hit at this level right here. Now, this is a nice trade. They're not all going to work as nicely as this. So this is just a really nice example. But I wanted to show you what the difference is. If we let that trade run, remember we had a 90 pip stop loss. In this case, we'd have a 240 pip win on this one. Now, again, they're not all going to be as nice as this. Some will be dramatically more. You'll get 4-to-1, 5-to-1. Sometimes you're going to get a 10-to-1 trade. If you have a fairly small stop loss and the market is just taking off, you can do really, really well. But again, that is not something that is going to happen regularly. It is something that is going to happen from time to time. And if we can take advantage of that, that is great. And this is the way that you're going to want to take advantage of that, is simply by trailing your stop loss along that 10 EMA. Now, I want to show you a filtering mechanism that is going to keep us out of some bad trades. So let's reduce this a little bit. And I want to take a look at some potential trades that may not have worked out. There's a couple in here. We've got a signal to go long right here. All right, so we've got this signal to go long. This one didn't work out. We didn't even get to manage the trade, really. This was just a nice, clean loser. And another one right here. So we've got everything, all the criteria is met for a trade, and it didn't work out. And again, we didn't even get to manage the trade on this one. Now I'm going to add another moving average to this. I'm going to add a 100 EMA. So let's go trend. I'm going to go moving average, and let's add a 100 exponential moving average. So I've got a white dotted line, and we're going to notice a couple of different things. What I want to be doing is taking trades in the direction of the trend. So now we have a bigger trend. We've got a longer term trend in mind. The channel, or these two 20 EMAs. This would be the 20 EMA channel now. So we've got this 20 EMA channel. I want to be trading in the direction of the side it's on of this 100 EMA. So if the channel is below, then I want to be looking for short trades. If the channel is above, I want to be looking for long trades. And if the 100 EMA is inside of the channel, I don't want to be doing any kind of trades. I don't want to be looking at any opportunities for that. I want that channel, that 20 EMA channel, to be on one side or the other of that 100 EMA. So with this being the case, this rules out this trade right here. There's no way we would take this trade because it's going against the greater trend. So we're only going to trade with the trending direction. And this is going to show us that that trade against the trend is not working. So we are not going to give our money to the market in hopes that it does work. And we're going to trade with the trend. And we'll find lots of examples of that. Here's a losing long trade that we would have not taken if we keep the trend in mind. This would be a losing short trade that we would not have taken if we're keeping the trend in mind. And again, we've got another losing short trade that we wouldn't have taken if we keep the trend in mind. And we have a long trade that didn't work out. We have a long trade that didn't work out. We have a long trade that didn't work out. And these are simply trades that we don't take because we are trading with the trend and not trading against the trend. So if you trade against the trend, that's counter trend trading, and that can be risky. Now, if you see that the market is trending very nicely and you have this really nice strong move down or this really nice strong move up, that is the direction of the overall momentum. And trying to make a great trade against the overall momentum can be a risky thing. There are ways to do it, but it is something that is risky to do. And again, you can see that the moves in the trending direction are bigger. We have moves against the trend that are much smaller, and some of them are going to be straight up losers that we don't even get the opportunity to really manage. Some we can manage and reduce the risk on the trades, but if you are trading with that trend, trading in the trending direction, we're going to find that more often than not, we're going to have more successful trades. And there's a lot of nice examples in here. This would be a winning short, but again, it's a little bit riskier. This is a losing short. This is also a losing short. This is a losing short in here. There could be a short in here. If I zoom in, maybe this one candle closed below that 20. So we can see that if we have this bigger term trend, we are finding that the market does tend to move generally more in that trending direction. So this is something that you may want to consider. Throw on a 100 EMA and take the trend into consideration when you are placing a trade. Again, you're going to find that the market does move in the trending direction when the trend is fairly strong. Now, if you have a market that isn't trending really dramatically, like this current market is right here, then trades in both directions become a little bit easier to do. But when you do have a market that is clearly trending, that is definitely going from up to down or down to up, then you may want to reserve your trades for just that trending direction. All right, so that is the Forex Power Pro trading system. It is really simple. It is really easy to use. And I really want to thank you for being here with me and allowing me to explain this system to you. And I hope you get some good use out of this trading system. Now, remember, there is a download link on this page. You're going to be able to download a zip file. In that zip file, you'll have the auto installer and you'll have the PDF manual for this trading system. And also, don't forget to leave a comment below. By leaving a comment, that essentially enters you for a chance to win a really cool prize. Again, thank you very much for being here and letting me share the Forex Power Pro trading system with you.